Hi, everyone. Um, can you hear me? Can everyone hear me? Good. Okay. So I'm Bayo, and I'll be presenting along with my co-sponsors another opportunity that we have in Northwest Arkansas, and this is in Centerton, Arkansas, and I think you're going to love it. So we're going to start with the disclaimer. And this is to just let everyone know that we're not financial advisors, we're not tax advisors, and you have to do your own due diligence and make sure you read the private placement memorandum completely before you make an investment. Okay, so this is the outline of the presentation. And we're going to be talking about the investment overview, the market overview, specifically letting you understand the growth that has been going on in Northwest Arkansas. Then we're going to talk about financial analysis. And we do have the lead sponsor team here, Justin, who's going to be, educating us about that. And then we'll talk about the timeline, the next steps. So I'm going to go ahead and start and introduce myself. Okay. So I'm the founder and CEO of Dr. BDZ Capital, and most of you already know me. And along with my wife, we do have our own units which we manage, and she manages most of the operations. And we also been co-GP in multiple deals, including senior living, oil and gas, and storages. And this is, going to be the biggest one so far, and we're very excited about it. Also, part of the team is Dave Pinston. Unfortunately, he said he was not going to make it today because his daughter is sick. So, but he's an important member of the team because he actually works for Asset Living. He had his own company before called Trinity Management Company, and he manages about 35,000 units in 17 states. And now they actually manage the units that we're going to talk about today, and the team is going to be managing this asset. So I'm very proud to have him as a member of my team. Next, we have Josh Harmon, who is, #1 individual real estate agent, especially in commercial properties in town and surrounding area. So Josh also has worked with Elevate Group in the past. So he serves as part of my due diligence. Josh, can you introduce yourself?
Absolutely. First of all, thanks for having me, Bayo. And Justin, bringing the opportunity. And, I appreciate everybody being on today. Me and Bayo have recently started working together with acquisitions of multifamily assets. But me personally, I own 314 units. And I manage most of those units myself. And one thing I can say about the Elevate team, I'm specifically done business with Brian Wagers, who's one of the, the sponsors, lead sponsors on this deal. We've transacted about, 250 units together over the past couple of years. Brian Wagers and I, who's one of the partners at Elevate Capital. And he's exceeded expectations every single time. So, more than 200% returns for his investors on each of the deals that he has done, with his groups. And, very, very, excited to be involved and be involved with this group and in this project because, Centerton is, a huge market in Northwest Arkansas, right next to Vendorville, Walmart headquarters. So, huge opportunity here.
Thank you, Josh. So I'm also going to introduce Dr. Raj, who's a strategic partner on this deal also, our co-sponsor, and is going to go over some of the next few slides.
Thanks, Bayo, for introducing me. Hi, those of you who don't know me, my name is Raj Venkatramani. I'm a pediatric oncologist based out of Houston. I have a master's from USC, an MBA from University of Massachusetts. I've been a real estate investor and entrepreneur since 2018, 2017, and I've invested both as a GP and an LP in about 1,200 doors. Justin Gruden is part of the Elevate CIG group. We are very happy to partner with them. They are the lead sponsor for this property. Justin, can you say a few words about your group?
Yeah, sure. I'm the lead acquisitions director for Elevate Commercial Investment Group. We're based out of Dallas, primarily invest in Dallas, Houston, Florida, and a few other markets right now. Acquired a little over 6,000 multifamily units since inception and have a little over 4,000 under management right now. So really looking in, like more A and B class properties and trying to stick to high growth markets such as Centerton, Arkansas.
Thanks, Justin. We're also happy to partner with Tariq El Musa. For HGTV fans, he's a celebrity and he has multiple programs there. And he's also an expert in flipping and rehab. So he's bringing his team. He believes in this project so much. He's bringing his money and his team to this project. Next one, please. And Dr. Bayo already mentioned Asset Living is going to be the property management. This is a huge company who is managing over 175,000 units. They have worked closely with Elevate CIG Group on multiple properties, and they have a good relationship. And as Dr. Bayo mentioned, the person who is going to be managing this property is already part of his team. So he has known that person very well. And Asset Living has multiple properties locally in Arkansas they are managing as well. So we are very confident about asset management's expertise in this area. I'll go over a few slides about what the investment overview and what returns you can expect from this property. Next slide, please. This is an executive summary. So the property itself consists of about 376 units. 232 units were completed in phase 1 and 2. The phase 1 was completed back in 2018, and then I think phase 2 was completed in 2020. And then there is a phase 344 units currently under construction. So we're going to be buying all 3 phases together, a total of 376 units. And our purchase price is $73.2 million. And our plan is to hold the property for 5 years. And currently we're raising equity of $30 million. The rest of it is going to be sourced by debt from banks. Next slide, please. So the next slide, I'm going to go over the actual returns you can expect. So our projected cash-on-cash return on an average over the whole period is 4 to 6%. It's going to be a little bit lower in the first few years because it's a Class A property. You can expect less, but on an average, you'll get 4 to 6% cash-on-cash. And our projected IRR for this property is anywhere from 16 to 19%. For those of you who don't know what IRR means, it's IRR's internal rate of return. Basically, it takes into account not only the amount of money you get, but also the time when you get it. So the money in your pocket next year is probably worth more than the same amount of money in your pocket like 5 years from now. So that is calculated here. So that's why the IRR is about 16 to 19%. And the equity multiple you're projecting is 2 times to 2.3 times the investment. What that means in practice is if you got $100,000, you're projecting at the end of 5 years, you'll get total return of $200,000 to $230,000. In other words, if you look at average rate of return, you're looking at anywhere from 20% to 25% per year. And on the right side, you see the waterfall, what you call as a waterfall plot. This deal comes at 6% preferred return. Again, for those of you who don't know what preferred return is, the first 6% of the profits go directly to the investor. Say you invest $100,000 and we make $6,000 profit on the $100,000 that year, you're going to get the whole $6,000. The sponsors do not get paid anything on that $6,000. So anything we make above that 6% profit, then we split with the LPs and GPs split in a ratio of 70 to 30%. What that means is 70% goes to the LP and 30% of the profit goes to the general partners or the promoters of this property. That's until we reach a 18% IRR, which is pretty good. And then anything above that, we split between the LP and the sponsors on a 50-50 ratio. And this basically gives you an idea of the properties. I already said 376 units. Phase 1 and 2 is already constructed. It's developed in 2018 to 2020. And the phase 3 is 144 units, which currently under construction. And this gives you a nice overview of the property. As you can see on the other side of the property, there are single family homes. It's a nice suburb here. And then property is currently 96. I think the latest data is 97% occupied. That basically shows us that there is a lot of demand for this units right now. And the last we heard is there are like always pending applications. There are like 26 pending applications to get into this property. One of the things to emphasize here is the builders, they always want to make sure the occupancy remains high. So they tend to not charge market rent on this property. So that gives us some opportunity to go in and buy it and charge market rent. So there is an upside for us when we buy the property. So these are the main reasons we love this deal. One is this is an off-market purchase. There is no broker involved. The Elevate CIG Group is basically purchasing the property directly from the builder. And in the few slides, you'll see that this is properties along the path of progress. Walmart is building a big headquarters just 3 miles from the property. There are other 2 Fortune 500 companies whose headquarters is located nearby. And we also talked about the immediate growth potential about the rents. We have potentially we can increase rents by $200 to $400 when we compare the rents in the nearby properties. And the other thing we like very much about this property is we are assuming debt at a very low rate. It's going to be 3.49%. The builder already has this loan. We are going to go and assume it. If you go out to the market right now to get a 3.49% loan, you'll never be able to get it. So this is just for the phase 1 and 2. They already have this loan, so we're going to assume it. And it's going to be a fixed rate. So that's another advantage. It's not a floating rate. So whenever the Fed raises the rate, it's not going to go up. We know exactly how much we're going to pay to the bank. The phase 3, which we are going to close in June of next year, again, the main team, the Elevate CIG, is in talks with the local bank, and we are again going to assume a fixed rate interest rate for that phase 3, so that we know our business plan can be executed and the volatility is not there.
Okay.
Thanks, Bayo.
Yeah, thanks, Raj. And so I'm going to piggyback on that and talk a little bit of our business plan. So, like for people that have already listened to our prior webinars about storages, it's essentially the same strategy. So you always want to get properties under market rate in which immediately you have an upside. So over here, since the builder prioritized filling up these properties, so they fill it up at a lower rate, which makes sense. But then you will slowly increase it up until the market rate, especially if it's a very nice property. And then we also modernize and add more smart features. I just wanted you to know that this is already very nice property, but you can even make it even more nicer because of the kind of clientele that we cater to. In this particular facility, it is Class A property. Okay, so you want all the amenities to be very functional, very efficient, and also we plan to create value and also improve the corporate appeal. So essentially, raise rents, make it look nicer and smart, modernize it, essentially. So this is part of our CapEx budget. As you see, there are a few things that have been added, and you see there is an electric car. I'm personally excited about that. The smart unit package and the charging stations, full upgrades, and this is going to be about $1.5 million to do this CapEx. As you can see, this is the current amenities, which is already nice by itself, okay? And one thing that is very popular among the residents is the golf simulator. So, it's like a cool thing to do in that area, alongside with the gym, the pool, and also like a sports kind of area where people can shoot pool, watch TV. And playground for your kids. So it is, very top of the line asset. So I'm going to also talk about the market overview. And because this is my area, we're about a little bit more than an hour away from this asset right now. So I can actually plan to drive down there, take pictures, maybe drone pictures. And so Northwest Arkansas, for many people, they may have not heard about Northwest Arkansas because only very recently it's been showing up a lot in the news, okay? So it's one of the fastest growing area in the country right now. And the reason for that is there's a lot of startup company, technological company, and also Fortune 500 companies that have their headquarters in Northwest Arkansas now. And many people have dubbed it the next Austin, in which it has a very rapid growth. And every single element that made it grow is also present here. There's like a lot of universities, that University of Arkansas is expanding really well there. A lot of young population. And also the technology company brings a lot of affluent people. The average income is, improved as a result of this. And as you can see, the top three are Walmart, Tyson Food, and JB Hunt, which we're going to talk about later. So there are many companies, like I said, with their headquarters in Northwest Arkansas, and the three notable ones, which are Fortune 500, are the Walmart, Tyson Food, and JB Hunt Transport. So one thing about these three companies is that they have products that is a normal staple in which it's going to provide jobs for a very, very long time. Okay, so everybody needs, to buy something in Walmart at some point. Everybody needs food, chickens, and also everybody needs transportation. So this is a chart of the growth in the past 10 years of different areas. And you can see the Centerton actually ranked #1 in growth. And on the next, it has grown about 400% in the past 10 years. So this is a well-located asset, okay, close to many it goes to Starbucks, Kohl's, Walmart Supercenter, and another, the Walmart headquarters is being built about 3 miles away from these apartments. So one thing to know though, is that all these companies, they just don't put their companies anywhere. They don't open their store anywhere, okay? Especially Starbucks. They do market analysis because, they understand the population, and they do this analysis to be sure that this can, it's a growing area and the area can support their business. So if some people have actually said that if you want to follow path of progress, you just have to follow a few companies, Walmart, Starbucks. Once you start seeing them opening in some certain area, and it's a remote area, for example, you should know that growth is about to come to that area. So this is just an area view of the Walmart's new headquarters, Apple-like headquarters, that is going to be built in Northwest Arkansas. So coincidentally, it's planned to be done by 2025 or so. So, and it seems to be like the range of time in which we're also holding all our assets here. So I think it's going to be a very good addition. Also, since Walmart started with this headquarters, they're actually requiring many of their workers to move, many of companies that want to work with them to actually have a base in Northwest Arkansas. And this also brings more business, more people, so we can stay rented. So this is just the average, talking about our occupancy in the area. As you can see, the current assets is 96% occupied, and there's about 37, last time I had waiting list actually. So, average occupancy is 98%. So you can't build them fast enough in Northwest Arkansas right now. It's like before you finish building, it's already, all occupied. And another thing to know is when we're considering assets, we always want to look at, is there any job growth? What is the average income of the area? So over here, the household income, median household income in 5 mile radius is about $85,000. So which put it in, the class A category in this area. And also most of the people renting these apartments, they're white collar employed, people with, bachelor degrees, master's degree or higher. And that's because of the tech companies that are coming in there. So this, it helps with your kind of a stable occupancy. And also, these are not the people that would basically, trash your apartment complex. So we're going to talk about the financial analysis, but I'm going to introduce Justin again, just to kind of go over this with us. And then we're going to wrap it up after that. Justin?
Thanks. Yeah, happy to dive into the numbers, which is my favorite part here. Not sure if that's favorite part for anybody else, but yeah, we can go on to the next slide here. So kind of like we mentioned, but we're buying this from the original developer. And, they're not multifamily operators. They're really just kind of driven by building the project and either refinancing or selling once it's complete. So, they're not really concerned on raising the rents, optimizing the income. Their, main goal is to get it occupied, get it stabilized, so that they can either sell or refinance out of their expensive construction loan, which leaves a lot of opportunity for the next buyer. So as you can see from the chart on the left, which is from a company called CoStar. CoStar is one of the largest third-party data sources available. A lot of commercial real estate investors use this. But yeah, just looking at this overall graph, you can see that we're kind of like, on the bottom spectrum compared to other properties in the general area, which, like I mentioned, leaves a lot of upside for us as new buyers come in and kind of bring these up to the middle or upper tier, which we'll look at here in a second as well. To the right, you can see where rents are going in this market compared to where they've been in the past. Last year, Bentonville was named the fastest growing city in the state and 28th fastest growing in the whole entire nation. So a lot of growth over the past, even just, a few years in this area. So going on to the next slide, we can see how our rents compare against other properties of similar vintage and nearby. So we picked a few different comps that were close by and of the same kind of vintage. So even after our projected rent increases, which, we know it's not going to happen it's not going to happen immediately. So we're projecting over a period of 24 months to bring these rents up to market, as leases expire, as leases turn over. Even after these projected rent increases, we're still below several different competing properties and still kind of in that middle spectrum. So I feel really confident about that. And, if we can get more, that's awesome, but feel really comfortable and confident where they're at now. So going on to the next slide, just a simple overview of our acquisition and disposition analysis. So we're buying all phases at the same purchase price per door. So, we're buying phase 3, which is going to be a brand new 2023 built asset, the same price as phase 1 and 2 that was purchased a few years ago, and exiting both at a 5-year hold period and at a 4.75% exit cap rate. Kind of touched on this in the beginning, but just really quick again, phase 1 and 2, which is the first 232 units. We're assuming a fixed rate Fannie loan on these 2 phases. That puts us at around 62% LTV and about 2 years of IO left on this asset, which is, you know, not always a bad thing. So after this IO expires and we start paying principal and interest, you know, we're just gaining more and more equity on the deal with each payment we make, which is, you know, it's the more equity you have in this property is going to be, you know, better for the disposition as well. Phase 3, similar story. We'll be closing on this deal when we receive the certificate of occupancy from the current owner, and then we'll lock in a fixed rate with a local community bank around 90 days before closing on that, and that's going to be based off Wall Street Journal Prime. Going on to the next slide. You know, we never, there's a few things we'll touch on, but taxes are always like the big thing that could make or break a deal. So we never want to guess when it comes to taxes. Each property we go after, we always hire a third-party property tax consultant to give us a year 1 through year 5 breakdown, which is exactly what we did here. I mean, it costs more money to do this. Obviously, it's not free, but you know, it's the right thing to do, and we want to make sure that we're, you know, confident when we pitch this to our investors. So, you know, like I mentioned, they give us a year 1 through year 5 property tax breakdown, and they usually include a best case and a worst case scenario. And if you go back and look at our pro forma, you'll see that we're using the worst case scenario in every year. So feel really good about that as well. Some different sensitivity analyses here. You can see what happens to the levered IRR if we were to sell it at a higher or lower cap rate. So just a good baseline to look at right there. Well, lastly, I'll touch on this. I think we're getting Watercolors to Centerton at a really good going in basis price per door. So like I mentioned, we're acquiring all phases for $194,000 a unit. Right now, by another broker in the market, there's a property that's about 19 minutes away, listed for sale, another A-class property at, as you can see, $260K per unit. So, I mean, again, feel really good about the basis we're getting on this property. You know, I'm really confident that if Watercolors did go to market and was listed by, you know, a local broker, that, you know, we wouldn't be getting anywhere near 194 a door. So I feel really good about that as well.
Thanks, Justin, for that. So this basically is showing here what happens if you invest $100K. This is our projected returns and how much cash flow you get every year. That's displayed there in the cash flow distributions. We mentioned before the average cash flow or cash on cash return is about 4 to 6%, but it's going to be lower in the initial years. And the majority of the upside is on the back end. This is a Class A property. That's the reason, because the equity keeps increasing, but the cash flow will be about 3 to 4% in the first 2 years, then 2.6 and 4.1. But if you look at the average cash on cash, it will be about 6%. And then the IRR we already alluded to, it's 18.8%, and the equity is about, in this based on this, you're projecting about 2.3, but I mentioned before it's 2.1 to 2.3. So this page basically shows how much cash flow you get each year. And we also, there is a lot of tax benefits in investing in this property. This is going to be a 2023 closing, so I wanted to emphasize that. So it's going to show up on a K1 in 2024 because you're closing it in 2023. But for $100,000 invested in the first year, we are projecting about $60,000 to $80,000 of depreciation. And throughout the life of the property, our projection is about $114,000 to $128,000 for every $100,000 invested. So it probably does come with good tax depreciation if that is what you're looking for. Next one. So this is a timeline. We have the webinar today. Actually, the investments portal is open, so you can go in and put in your reservation today. And then we want you to wire the money as soon as possible, because if the slots get filled, we basically prioritize based on when the money came in. So it's first come, first serve basis. So if you're decided you really like this part, want to invest in, we want you to get it in as soon as possible. And the final date for funding is December 10th. And our closing date is currently January 5th of 2022 for phase 1 and 2. And then the phase 3, the new construction is slotted to be closed in June 2023.
Yep. Well, thanks, Raj and Justin and everyone. And we really wanted to be very quick in the presentation, because you can always have this deck on the portal. You can read up all about the information. You can reach out to us. Most of you have my cell phone. You can call me anytime. We can discuss. I'll physically go there, take pictures, video, whatever, can be done, because, I live close by. And, so we just like to start entertaining questions. Now, if you have any questions, please go ahead and ask.
What's the minimal investment? I think I missed.
Oh,
that.
yes.
It's in the next slide.
My bad. So the minimum investments is $100,000, and this is a first come, first serve. And Justin, correct me, if I'm wrong, but I know that significant amount has been raised already, and so it's filling up very quickly.
Is there? I apologize. I'm not sure if I missed it, but is there like a quarterly or monthly distribution throughout the 5 years hold?
Yes.
Yes, I think this was the previous slide too, last two slides. Our distribution is expected quarterly, starting about 6 months after closing. That is our projection. You'll get updates every month after you invest. There will be a monthly updates, and then you get a K1 before tax. We try to give it to you before tax filing. So there will be monthly updates and quarterly distribution, but the first distribution we're expecting to start about 6 months after closing.
This is George Ozude from Houston, Texas. I'm curious as to if there's any reason why the original developers hadn't finished phase 3. Phase 1 and 2 were finished 4 years ago. And just curious if there's any headwinds or challenges that they face that you guys are aware of.
It's a great question. Actually, I'm not aware of why they did not start up until recently. They started phase 3 officially about, I want to say like 3 or 4 months ago. I think you can see in the pictures, it's, in progress and rolling, and expected to be completed by May or June of next year. So yeah, I'm actually not totally sure on that or why they didn't start immediately. But I can definitely kind of like relay that question to the seller and get back with you.
Appreciate it. Thanks.
Also, another thing that also happens with many of the builders is usually builders, they come in with the mindset of build then sell. They're not operators, and many times they, between doing the phase 1 and 2, they're running the operations and trying to build the third phase. Sometimes, many builders, it might be too much for them because they're not operators. So now they are tasked with the job of trying to operate, the first 2 while trying to build the other one. So many builders actually do, exits like this.
Yeah, and I used to work as a multifamily underwriter for a commercial bridge lender. And I know like sometimes on larger size properties, developers wouldn't necessarily, if they have like a 400, 500 unit property, they're not going to build obviously 500 units at once. So they'll do it in phases. So maybe it had something to do with the size and things like that and building it like that. But yeah, as far as the timing, I can definitely verify that and get back with everyone.
So you can always reach out to any of us, either Dr. Bayer or me, with questions. I put my contact information. I'm sure you guys know Dr. Bayer's contact information. So yeah, please feel free to reach out to us with questions. And on behalf of Radar Capital, I want to thank you for attending the webinar. Go ahead, Bio.
Okay. Yeah. Thank you, Dr. Raj. Very technologically savvy. He put everything together. So I really appreciate it. And thanks, Justin, for coming. Because I really feel like it was necessary for a member of the team to come and, at least show their face, let us know what's going on and the financial analysis. So thank you very much. And thanks, Hammond, for coming also, and we're going to be doing, and also I'm hoping we'll be doing even more deals together with Justin Group in the future. So, okay, if there's no more questions, we're going to have to stop the meeting. Okay.
Thanks, everyone.
Thanks, everyone.